Alrighty. If you're here, thanks for the purchasing of this file package. We're going to look at in the first set is the typical workflow that I go through to understand everything I need to know when it comes to uh, data and what types of call it high frequency trading strategies to choose. So in here, among the data, all this data comes from, in my case, using MotiveWave, the platform, and connecting it into Rhythmic, my account via my futures broker. My futures broker is EdgeClear. I'm my FCM, uh, futures commission merchant is Phillips Capital or Phillip Capital. And then once you get everything set up with Rhythmic, which is about $40, $45 US, you're able to using something like MotiveWave and then generate the data. Uh, Usually, to do this is going to cost you quite a lot of money. I've talked about Data Bento; they could be in the thousands of dollars to do equivalent, but with Rhythmics, it's $40 with a futures account. Once you get set up and funded, you're good to go. So here we have different types of data. We can do the um, typical timestamp, price bid, ask, and then the volume. In here, for this data set, we can go into, I could pretty well ask into literally into the thousands. And you see it only takes me back, this is pretty well 2 days worth of data. And this is again on the CME, the Chicago Mercantile Exchange. That's pretty powerful knowing that. Okay. That's real market data. Can you go farther back? Probably. And that's probably why you need Data Bento. But my philosophy is now with AI, and I've shown in other videos, doesn't make sense for me to kill yourself on the backtesting process because AI can do a lot of that for you, as you'll see in this course file pack. Well, I don't know, whatever you call it. So in here, we also have Bitcoin. And again, this is a F6 contract, minute data and hourly data. Okay, so I'm going to load up each one here. And this is your typical open, high, low, close, and the volume as well. Okay, and you can see here the data is probably going to be just as much, close to 10,000. And this one goes all the way back to, once again, January uh, this year. Okay, sorry, that's 1 minute data. All right, and then if you want hourly data, which might be worthwhile if you're going to do the high frequency trading stuff, so here we've got hourly as well. Okay, and this one goes farther back. So this might be better. So this one's going back to October of last year. So that's going to be 3 months worth of data. You may be able to get more data, uh, but again, depending upon your strategy and your time frame that you want to analyze and trade, um, it's different. Because people want to trade on hourly, 4 hour, daily, weekly, whatever. I don't know. But obviously, this is ultra low latency. So you're most likely going to be trading on the tick when you can. So they're using the AI that I've talked about. You can ask it to generate the different trading strategies available. So that data that I've just shown you, you can feed that into the AI as part of your prompting. And it's only for the 2 days of January 1st and 2nd of this year. And then it goes over all of the different types of, remember, we're looking at bid ask data, not open, high, low, close. Right? So it gives you a very detailed breakdown on the decomposition of that data. Okay. Again, I'm no expert on any of this, but this is where you go from like in my case, high school level, even nursery school level of math to PhD level math. And this is where a lot of the um, brain power in the Ivy League schools at PhD level, this is why they're worth probably into the millions of dollars per year when they generate this on their own. But because now we're living in a world of AI, we're able to um, get the AI to do it for us. The question is that people are at, is this reliable? That's the question. You can see here we got something called temporal clustering coefficient. Some of this I've never heard of. This right here is the questionable one on quote stuffing. So there are formulas that you can use to see if there's quote stuffing within the data to protect your trading. Also in the API from Rhythmic, there are some with C++, where you can calculate the aggressiveness of the data itself. I've also shown in the coding before, if you were to join my membership, my expensive elite membership, where you can use the C++ to download. I can't really say in real time. Could be in real time if you code it up correctly in the prompting for the AI, to do it in real time to analyze the depth of market, and the data as it's streaming into your program. Here you can use iceberg analysis with the volume weighted average or VWAP pricing, looking for iceberg orders, and this is the detection. We have different formulas we can use, and you can get right down to the nitty gritty of it to really build out very sophisticated uh, formulas. So again, this is just the start of using ultra low latency. And again, this is on any data set. This can be on anything that's available through the CME. Again, I only choose this Bitcoin because it's the most popular that people want. So I'm using Bitcoin as the example, because that's the most popular. Okay, there's going to be the crypto traders, Bitcoin traders in retail with the retail exchanges. This is what where the institutional high billion-dollar operators firms will be like BlackRock's and whatnot will participate in the CME and maybe some of the other bigger regulated exchanges, but the big one obviously in the world is going to be the CME. Okay, so here we can look at the microstructure of price discovery. So if you're trying to watch some of these so-called gurus, I personally am at a point where I'm no longer listening to them because what do they know? Okay. And on top of that, you're going to pay a lot of money to go through what I'm showing you here. That is again generated by AI and how to do this properly. Again, I'm not an expert. I will most likely reverse engineer this. And I keep saying run it through a debugger. Okay. Here's where it gets very interesting and very proprietary that probably a lot of the big multi-billion dollar firms are using are the unknown algorithms out there, like this has brought information. Okay, and again, these are known now because of AI. A lot of the AI that I'm seeing, especially the unknown. I'll give you an example: DeepSeek. DeepSeek in China came out of a quant modeling shop as a hedge fund, and I guess the founders figured out there's probably more money to go to become like a AI shop versus a quant trading shop. There's probably more money at that because now with DeepSeek, which is originally using these same mathematical techniques, are now, I hate to say it, but they're supplying to companies like Hyundai or not Hyundai, Huawei. I mean, they're the biggest infrastructure uh, tech company in China, and on top of probably the Chinese military. That's where DeepSeek is gone and it's all secretive. But this is similar stuff that DeepSeek's capable of. But we're way like DeepSeek, the revolutionary version of DeepSeek came out nearly a year ago. So you can imagine where we're at with other competing LMs, either out of China, out of elsewhere, US, and wherever else. That's probably way more advanced than this now. So here we have something called the Chi Lambda. We've got the AIM Chris optimal execution. These are what, again, most likely HFT shops are using, or they're getting the quant researchers to develop their own homegrown modeling, or they may take these, like with what they do with Black-Scholes, and build out derivatives and specific formulas and equations uh, using the where Black-Scholes is the base for all these different types of mathematical models. So here we got institutional market making secrets. Okay, so this one's probably going to start getting out there as an example, but there's many different optimal ways to do it. And again, it's including your time series. Here you got your risk aversion, order arrival, intensity, and so on and so forth. very secretive stuff. But then it gets more interesting where you can apply this other formula for the risk management. If you've seen some of my other videos, well, now I'm starting to add in a risk management component among what I'm currently doing with the client server stuff, because you got to remember you have choices here with Rhythmic API. You can either go with the Rhythmic API, and you can only allow one connection into the API and keep it active. So in my case, that's where I build that client server model where you have the different clients, unique strategies, and maybe obviously unique assets that I'm going to trade, communicating with a server, and that same server has to deal with that data and the modeling that comes out of it at the same time, communicate with one-to-one basis or relationship basis um, with Rhythmic as well. So again, my prompting is very unique, and I've been doing it so long now. I know exactly what to prompt for. One of the ones is the trigger points for your entry and exit. So I'm able to now use where it just gives me the information I'm looking for, volume surge indicators, thread compression. So a lot of that's not being seen in the backtesting process, both in the Java script and the Python as well. This is the underlying behind the scenes, call it invisible type of formulas that you would use that gives you an edge over everybody else. So this one's another well-known one is the order book imbalance as well. And again, we're looking at the bid and ask as well and how it's coming through the option chain. And on top of that, with the futures contract as well, because if you took my futures and options course, what's unique about it is that you can blend your futures contract and then have multiple option chain um, uh, data, I'm sorry, date chains that you can watch a trade off of, and you can also trade individually and create hedging opportunities or um, arbitrage opportunities as well. So we can go really crazy with this stuff. This is just the first step, even though it looks complicated. And again, throwing in the C++, yeah, it's. But I will never ever, in my wildest dreams, go out in public explaining all this as well. This is a pretty standard one as well. This OU mean reversion, all Ornstein Ullem. You can tell I'm such an expert here on my pronunciation. So here's the key. Options and futures institutional data only you're going to get with high volume and high liquidity is going to only come from the CME. Okay. So here, this is where the advantages of using the CME specifically in options chain data, where we can do all of this interesting options, or sorry, Greek analysis on top of the implied volatility using, and I've got a video out there using implied volatility surfacing. And as you may see, one of the advantages with the volume surfacing, you can get some very interesting info out of that. So here's where your order flow is going to come from. Uh, the CME market data, options pricing reporting authority, and the CBOE. These could be when you get direct market access. Hopefully, you've seen enough videos either in my Quant Elite or just in my public YouTube stuff that you know that there's once you go into the direct market access and you have a big account, it opens up another world to you where you will get access to proprietary data feeds, expensive ones. That's why you need a big account, like a million plus, to really take advantage of it and be able to see unique data perspective that you won't get anywhere else that CME, whoever else, a third party may provide that over time the AI is revealing to me. And if you follow all of my secretive my quant elite group on my website, you'll see those feeds uh and which ones to use. And again, you can build out modeling on those data feeds if you get access to them. I don't, because I don't have a big enough account yet. But you can see here, we have a volatility surface, the raw modeling, institutional Greek analysis. Here's one I've never heard of, Vanna Volga. And again, you kind of want to look at my course for that because I go in pretty in depth, and this is much more in depth as well. But with the course, with the options and futures course, it goes into at a high level how to use futures and the various different types of options strategies you could use to really take advantage of the data that you see that's getting streamed in. Here's another one that's standard as well. Dickey-Fuller test. That's for co-integration. Um, Another one, Johansson co-integration and error correcting. This one's not used as much, but I'm seeing it more and more for hedging with the Kalman feature. I knew about these when I first started. I just was never an expert at it, and I'm still not using these formulas. But the only way, if you're like me, not strong in math, the only way to go through that is running the data step by step through a debugger. Okay. So again, we have all the different machine learning type of strategies as well, the hidden Markov as well. And then these are now the breakdown using some of the machine learning as well. Deep reinforcement, that's an important one. Again, this is beyond me, but one day I'm going to have to sit down and go, yeah, I have to know this stuff. Markov decision process formula. We have a reward function as well. Most likely not talked about, but this AI does reveal that with the Q network architecture I've heard about as well. Dueling, double DQN, where you can prioritize on the data. Um, and again, these are the different streaming capabilities that you can only really get from Rhythmic. Setting targets and having some kind of relay here, all mathematically done. Um, Again, proximal policy optimization as well. Temporal convolution for tick data. That's another AI technique as well. Temporal convolution. Then everybody kind of knows about this graph neutral network as well. Um, so again, we're getting more into the algebraic way of looking at this with tension mechanism, multi-head aggregation with an encoder, decoder. And this is really nitty-gritty, low-level machine learning algo stuff. Again, this is again on neural network and graph-based as well. So you could probably run this through your own graph neural network, or maybe have it in a high-speed one, like I don't know KDB, which some institutions use, or maybe have other open source solutions as well. Could be anything. So again, we have the order flow analysis here. Looking at the volume bars, dollar bars, time imbalance bars. This is a kind of known one, but not really well known out there. Is the volume synchronized probability informed in trading? That's important there. The informed in trading. You want to know what the bigger shops are because hopefully you're aware when you go into this any retail or in this, you're going to have the big shops having all this mathematical process, some of it legal, some of it ethical. They'll use it even unethically and kind of in a real world get away with it. But they are the informed traders. They're looking for what you're doing among thousands of other people in the exchanges, trying to figure out what you're doing and take advantage of that with the quote stuffing and front running your trading as well. So that's where you got to be very important to understand the informed trading end of it, bulk volume classification, VPIN calculation. So we're looking at the total trades traded, in this buy and sell classification, and so on. Another one that's really used is order flow toxicity. Again, I'm no expert in this using this Kyle Lambda process and this Emihood e-liquidity. And this is important to know about whatever you're trading, not just Bitcoin, but some maybe other altcoins or e-liquid uh, assets or instruments that don't have the liquidity and where you get a lot of slippage coming in. But a lot of the dumb money don't know this stuff. That's the sad part about it. And then here's where we start to get into the market making on the profit level as well. Probability of informed trading. Okay, so this is again from just pure data. I no longer listen to people at all, at all, with their hunches or what they think, because it's useless information. I'm part of a WhatsApp group with really similar traders, and quant researchers, portfolio managers, and you can tell these are institutional level. And time again, they look at the data and only use the data for the forecasting, nothing else. Okay. People may not like to hear that, but that's what the smart money does. If you truly want to build the wealth here, this is what you're going to learn. Okay. And these are all the techniques that you're going to look at, which the formulas will give you the equations from a quantitative perspective will give you. Look at this. So we have an extremely high major information event. Just looking at the data, very powerful. Again, latency arbitrage framework. This is really important. Raise probability cross exchange arbitrage detection. That's where you could use the CME. Maybe you could use the Bitcoin derivative market. And if you have access to the prime or any other, these are your trading opportunities that you have. And again, you could use any of these different triangular as well. So there's that. Okay, so it goes on and on. Q priority, Q optimal, Q entry. Again, I mentioned about the modeling for volatility surfacing, arbitrage free surface arbitrage. This one's well known, Dupire as well. I could go on, but I just wanted to give you a high level of this. Thanks for watching for now.